Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for February 22nd, 2021. Please see our disclaimer for important information. Well, to start off the week, let's go ahead and take a look at our COVID tracker. Here's our 7-day moving average of new daily reported cases, as well as the 7-day moving average of daily deaths in the orange. And so you can see the blue line, which is new reported cases, is going down precipitously, very good sign. And the daily deaths, which run at roughly about a 10 to 20 day lag, are beginning to roll over as well. Tend to be a little bit more sticky, but we're getting less traction. And we've got a real interesting data point coming up, actually from some research done in Israel on some of the vaccination. We'll talk about that in a second, but the reported caseload would and should go down the more people that we have vaccinated. Here's our hospitalization rate. Again, another positive sign that we've got hospitalization rates going down fairly precipitously. Our ICU rates are not going down nearly as fast, but they're trending in the same direction. So, if you look at where we are now relative to prior cycles, we're getting back down a little bit closer to where we were at our peak during the midsummer rise. And then on hospitalization, aggregate hospitalization, we're trending down, but we're not quite yet to where we were midsummer and certainly back in April as well. Here's our chart depicting vaccine doses administered in the U.S. And you can see the line really begin to kind of flatten out a little bit. And obviously, anybody who's been listening to this that's been in Texas over the last week knows that we've had a major weather event. And frankly, the weather event has transgressed state borders, and it's impacted much of the Deep South and much of the country for that matter. And so I would expect when we get those 7-day moving averages looking in next week that we're going to see a rather significant downtick because of all the weather-related disruptions. But in any case, the overall, if you kind of back out the impacts of weather on last week, when we get that data, I think what we're going to see is that that line continues to move higher and higher. Data from Strategas on daily average of vaccine doses, and I've been, looking for a way to kind of represent this on a week-by-week basis, kind of an aggregate. The prior chart gave you almost a daily run, but this is a weekly aggregate. And so I think what this does is it helps to paint the picture, even though we don't have last week's data in quite yet, that we're accelerating the pace at which vaccines are being administered. And this is actually very important as we kind of talk about the possibility that new research has come out with regard to the Pfizer and Moderna vaccines, suggesting that perhaps they could back away a little bit from a dual dose regimen and just provide a single dose, which would have the very similar efficacy to the J&J or Johnson & Johnson vaccine. This is the chart that I mentioned earlier about Israel. So I think, all the country data that you look at, what you glean from that is Israel has done a phenomenal job as vaccinating their citizens as a percent of the total population. And so as a result, they actually they're building a fairly good data plan. So we know what the experience is beginning to look like with regard to the immunity factor for people that have been vaccinated. As you can see here, this breaks up the age groups, and you look at, I'm going to focus really on the left-hand side. So you've got a 0 to 59 age cohort, and then you have that really high risk above 60 cohort. And so obviously we had a very strong spike in cases worldwide heading into the new year. And we know vaccines began to, roll out really in the second to last week of December. but as they were administered, the evidence is showing here that hospital admissions for the above 60 cohort are actually dropping at a fairly stout rate. This is a really positive sign when you think about admissions and cases and those types of things. This is really helping to kind of helping us to understand really the positive impact that vaccines are having on overall infections and hospitalizations. And here's our path to herd immunity that we've talked about. We mentioned for quite a number of weeks now this notion of herd immunity. Really, the level of overall immunity, whether you've been vaccinated, whether you've had it, or whether you perhaps have had it and just never knew it. Now, this is something that there's no magic number, but the consensus is that herd immunity exists somewhere at 75 to 80%. And so we've had charts like this in the package before, but nothing that's kind of given us a projection out to the beginning of next year. And so where we are now, obviously entering this year, we were at a little bit of a bubble on new infections. We're getting people vaccinated, and that's accelerating. We saw that just a single chart ago. And so with that, we're increasing our overall path towards herd immunity. And so, this chart, which is from COVID-19projections.com, and as reported in some research from Fidelity, is that, we're getting a lot closer to this herd immunity by the summer. And so when you think about all the events and activities that happen over the summer, vacations and sporting events and heading into the fall, that this paints a real positive picture for that. And so when you think about all of the second order impacts, which are spending, travel, leisure, hospitality, those things that, by themselves don't make up a huge part of the economy, but also lead to other types of spending and things like that, which absolutely does help the economy, that it gives you a better feeling about our ability to maintain growth, certainly in the second half of this year, and even some related momentum heading into 2022. This is a chart by Bloomberg. It kind of emphasizes some of the points that I was just making. And as I've said, based on a lot of the reading that I've done, again, this is not my own opinion. This is almost like a synthesis of other things that I've read that, we could easily be in a point here in several months where we literally have more vaccines than arms to put them in. This chart projects out through July the amount of doses that can be produced by the major producers. And this does not include AstraZeneca, which is now in force overseas, but it represents Pfizer, Moderna, and Johnson & Johnson's therapies. And as I mentioned a little bit earlier, there's been some new studies that have come out that have suggested that perhaps you could get a strong immune reaction with just a single dose of the Pfizer and Moderna, and that in fact that you don't have some of the onerous cold storage requirements for Pfizer that people thought originally, that you can store them in a typical freezer, which is negative 20 degrees, as opposed to having that, the hyper-cooled negative 70 degree environment. So, if you assume that, and if the health authorities move ahead with this thought that, hey, we can give people just a single shot of Pfizer and Moderna as a way to get more people inoculated, well, obviously you double your ability to vaccinate people. And so I think, with that as a backdrop, I think it's clear from this chart that, that we're on a real solid glide path to getting more and more people vaccinated. And I think, frankly, we can continue to support this geometric increase in vaccinations that we saw a few charts ago. Here's our chart or table rather from First Trust on high frequency data. And as you can see here, a lot of the data that we've had noise in has turned positive, frankly. We've had really the soft spots here. We've had a little bit of softness, unusual softness in the labor data as of late after a lot of momentum last year. And we've also got a rail car number, which looks down both in the weekly study as well as a month over month. And while that in and of itself has been something that we've kind of looked at in a positive light, that we've got more trade going on. I've got a couple of charts that kind of show that we really shouldn't have to worry about this. Production's going really strong. Trade is picking up, even though it remains depressed overall. But when you look down the column here and you see hospitality and the restaurant and dining industry, TSA checkpoint data has really picked up lately, and also the supply of motor gasoline in the U.S. And again, going back to what I said before about this recent winter storm, that number could turn negative. Some of this data could turn negative briefly, but again, I would probably focus on that month over month data for probably the next 2-3 weeks. Okay, well, let's talk about the economy just a little bit. And on the left-hand side, we've got the Bloomberg National Economic Expectations Index. And on the right, we have some projections from Goldman Sachs, kind of taking that optimism on the left and kind of translating it into what this fiscal stimulus can do for our economy. And it's just kind of a real quick gut check on where we are in terms of the vibrancy and then the enthusiasm that I think will underpin this continued growth this year. And you can see on the left-hand side that expectations continue to rise, after kind of falling a little bit towards the end of the year with new cases. Obviously, having that daily 7-day moving average of cases and now deaths beginning to roll over has been a real positive from a sentiment and kind of a psychology standpoint. So that's helping to drive that expectation index a little bit higher. Now on the right-hand side, you can see, what the impact of both the current stimulus and what the future stimulus, primarily the future stimulus, is going to do for the economy. Now, this isn't necessarily a gross domestic product number here. These numbers that where all these bars add up to, that's not what GDP is going to look like, but this is just the contribution of fiscal stimulus to GDP. There's a lot of other things that are negative that are weighing down our economy right now, but this is kind of the net benefit. So by this yardstick, the biggest components, or I guess the biggest periods of a boost in the economy from fiscal stimulus, quite intuitively are going to be second and third quarter, because we expect to get this stimulus passed probably by reconciliation, perhaps at the beginning of next month. So not as much of a first quarter benefit, but certainly second and third quarter we expect to get a more meaningful benefit from the increased liquidity sloshing around in the economy. And then it trails off over time, but ideally by then we won't need it. I think a lot of people probably would argue even today that with the strength in spending and overall sentiment, and at least this modest growth in the job market, that perhaps we don't need a stimulus. I do think a targeted stimulus will be beneficial, especially if it hits lower income folks, because they will spend it. And if it's targeted to help business owners have access to basically sustenance and expansion capital, those will both be net positives for our economy. Here's a couple of charts on gold. Obviously gold was a real darling. Interest rates were falling. Real interest rates were becoming more negative. And gold, frankly, got ahead of itself a little bit. And we've seen kind of a consistent pullback where this 50-day moving average has now clipsed and broken through its 200-day moving average, and that's usually a bearish technical indicator. Now, I think the conventional wisdom is that with real rates remaining negative. Now, overall interest rates, and we'll see this in a minute, are going up, but so are inflation expectations, and with that, it's maintaining that negative real rate standpoint. If you take the nominal rates and subtract out inflation, you get a negative real rate. And generally that's going to be positive for gold, even though it necessarily hasn't lately. So the chart on the right is from Bank of America. And so this is kind of where we are on a fund manager survey standpoint. So this is looking at institutional investors that manage money and asking them, well, how do you feel about gold? And right now, they do believe that gold is undervalued for the first time since last June with this pullback and with this technical break. We call this kind of almost like a death cross if you take the 50-day moving average and run it through the 200-day moving average. But at least from a fundamental standpoint, you have a lot of optimism behind gold right now. This is another chart from Bank of America, frankly, another fund manager survey question. And it's really kind of getting at the root of how much risk taking is going on here. We always have in these charts of the week, we've got data and charts that kind of suggest that there's froth in the market. We could be set up for volatility, that the market using history as a yardstick is stretched in terms of valuation. But if you look at this, you've got an all-time high in institutional or fund managers, institutional wealth managers, interest, appetite, and interest in taking risk. In fact, we haven't seen this in a while. We haven't seen this, since even before, the tech bubble, and even before, we went into the global financial crisis. This is a very unusual data point to be seeing, and I was very intrigued with this chart when I came across it. So, just know that there's a lot of optimism being built in the market right now, and it continues to actually go higher. And when you get, I usually tend to think that when you have some differences of opinion out there as to whether the market is valuable or whether it's overvalued, having that difference opinion is very healthy, and I think it's very constructive to the market. Now, if you got everybody that's aligned one way, which clearly this suggests that all the fund managers are extremely positive, that's a time, frankly, when you should take a step back, take a deep breath, and say, all right, what are the fundamentals telling me? Because usually there's a day of reckoning in this, where there's a negative surprise of some sort that nobody factored into their analysis, and it could turn the market into a 5 to 10% correction in a pretty quick fashion. Here's a percentage of U.S. companies, publicly traded companies, with a market cap over 250 million that this is an indicator of those that are not profitable. And so this is actually a chart of ones with positive earnings. And just to kind of put a cap on what I said earlier, without a doubt, you've got a lot of optimism out there. That's undeniable. You've got a lot of companies that have been impacted by COVID, so their profits are down. Profit expectations are actually really high. But this is kind of a look back. This is looking through the rear view mirror and saying, well, what are the demonstrated earnings of these companies? What this tells you is that we continue to have a rise in speculative companies that aren't earning money in our U.S. Publicly listed register of companies. And so more companies out there are not making money is the bottom line. And, it gets harder to kind of put a value on a company if they're not making money. You have to use different measures like book value of maybe operating profits or revenue. So this is creating a bit of a challenge on the conventional valuation approaches for the market. All right, housing data. So I love looking at housing data right now. It clearly, is regional in nature. This is a national number produced by Piper Sandler. Single family starts on the left-hand side in that darker color. That's actually at a spike. Now, obviously, we need a lot more because national days or months of inventory for single family homes for purchase is exceptionally low. So we've not been keeping up with demand insofar as supply is concerned. And multifamily, we've seen a bit of an uptick. These two tend to run in parallel, but they're not necessarily related and driven by the same factors. Obviously, from a single family standpoint, you have a lot of homesteads, a lot of you have household interests in those. And multifamily are in many circles treated as commercial properties because they'll typically have a for-profit ownership mechanism in a lot of cases, and developers that are obviously looking for return on investment there. But as you can see, dating back to the global financial crisis, that these have moved fairly tightly, except for just recently when single family starts have really kind of taken off. But I think to get the housing market back into balance, you're going to have to see that number move a lot higher. All right, home builder optimism is pretty high. It's off its peak, but it's still pretty high. So obviously home builders are looking at it from the standpoint that we have a lot of demand out there and rates are still low, even though they're moving a little bit higher. So we've got traffic of prospective buyers and talking with real estate agents that I know here regionally. There are in some cases 60 to 90 offers for every listing here in the Austin metro area, and that's just a phenomenal occurrence right now. So you've got a lot of interested buyers, not a lot of inventory. So from a builder standpoint, you're just happy as a clam right now because you've got a lot of demand out there pushing you to develop more housing stock. Housing inventory collapsing is capsulated in this chart by Arbor, and you can see this kind of breaks it up into different percentile groups. But essentially the median is the black line is the area that I want to focus on here, and that's clearly down. And this is obviously feedstock into this home builder optimism calculus. And even though you've got, like I said, a lot of single family houses that are being built, it's clearly not keeping up with this demand. And so we're going to have to, follow this and hope that we get more inventory out there to kind of create a better home price balance. We know prices are up considerably right now. We've got a lot of people taking home equity loans. And it's driving more of an asset bubble in the real estate side, which we want to make sure that we don't prick that because most households get the majority of their net worth from their homestead. All right. Well, here is a chart again related to the mortgage industry, and what I found interesting in these two charts. And they really tell the same story, is that the overwhelming majority of the credit being extended for mortgage lending is to higher credit borrowers. And so if you think about this, you've got lower credit folks that in some cases are getting credit, they're getting financing, but most of it's accruing to those that have good credit. And so it's kind of almost bifurcating the market a little bit. And obviously on the chart on the right, you can see that the amount of mortgage volume really spiked, and this is kind of been going on since 2019. Interest rates were higher, but they were low in aggregate, and we had a lot of mortgage demand, and the housing market was really beginning to take off. Now, that chart on the left, you've got over 70% of mortgage loan originations last year to borrowers with a credit score of 760 or above. I mentioned this earlier, and this is just the spike that we're clearly seeing in homeowners with prices moving higher, home values moving higher. Those with equity in their homes are pulling out more of that equity. So, again, what do they do with that? They can obviously, renovate their homes, build pools. They can use it to pay off debt, and they obviously, they can use it for consumption as well. And so, I think this is perhaps a positive indicator. It's something that we clearly would have expected with low rates and increasing home values. And I don't think we're done on this yet. I do think interest rates are moving higher that are going to put upward pressure on mortgage rates, but I think they're still going to be low enough in the aggregate that you're going to have a lot of interest, especially with the prospect of home values continuing to increase at a reasonable clip, that you're going to see more of this cash out activity. All right, so back to the economy here. So I mentioned shipments and durable goods activity being relatively strong. And we can see that in the chart both in the upper and the below. The upper represents the shipments index, whereas down under you see essentially container expenditures. I mean, these are durable goods expenditures. This is freight, if you will, in a nutshell. And in that high frequency data, we saw rail shipments down month over month. And at the time, I said, I don't want you to get caught up in that kind of noise, because the trend lines are clearly moving higher, and we haven't seen really any stall in the momentum for durable goods shipments, for freight activity coming off the low last year. These two charts are really evidence of that. And in fact, we're seeing, it's strong enough that we're actually seeing positive year over year. So, I mean, we're past the point of kind of recovering what we lost, and now it's actually growing beyond where we were a year ago. This is something that we're going to want to monitor. I've talked about this, at least several times over the last month, and this is this issue that we're really beginning to pay attention to about import prices, and those are going up. Now we know that we've got a weak dollar, and so a weak dollar, to say a weaker currency relative to currencies in countries where you're importing from. If those other currencies are going up relative to the dollar value of what you're importing when you convert it to dollars is actually higher. So this is the idea that when your dollar is weak, you have the risk of importing inflation, and that's a lot of what we're seeing here. And in a lot of cases, when we've seen these pockets in the past, we've had producers that have absorbed those costs and just accepted lower margins. But I think we're at a point now, and certainly a magnitude of this trend here that you can clearly see on the right-hand side of it, that we're at a point where producers are going to have to begin to pass that along. And you're going to see more price increases throughout the production channel into the final products that we see. And whether it's durable goods, whether it's washing machines, whether it's even automotive components going into the final production stage of an automobile. But clearly, I think this is something that we're going to have to continue to watch. I want to get back a little bit to what the fund managers, what the institutional wealth managers are thinking right now. And so I think this it does a good job of capsulizing, I think, where a lot of my peers think we are. And what's really interesting is, I didn't expect that many to believe that we're in a late stage bull market. I frankly thought that more people would think that we're in a bubble right now, which fueled by liquidity and asset inflation, from unprecedented monetary stimulus and additional fiscal stimulus on top of that, at a time where, perhaps not all of it is necessarily needed. But, I think this is kind of interesting. If it were, me responding to the survey, I would put more emphasis on a bubble, more of a short-term bubble, but perhaps a bit more of an earlier stage bull market if you're looking at over the long term. And I think it's going to be a slower growth stage. I definitely don't feel as much that it's a late stage bull market, because we really kind of almost reset the clock when we had the COVID related shutdowns last year, and kind of re-entered this almost this new market cycle, if you will. But I would tend to think, looking at this data, that we're probably in more of a near-term bubble, but on a long-term basis, more of an early stage new bull market that's perhaps going to be a little bit less robust and perhaps a little bit more rocky than we've seen in recent memory. So this is a chart of short interest across the market. And it actually has some breakouts here for consumer discretionary and healthcare. But, as we kind of cycle through the end of this GameStop episode, where kind of the individual retail investor kind of took on the sophisticated investors and had a brief victory. Typically a short interest, which, if you're a short seller, and these are sophisticated institutional investors that do this, and so if they feel that we're in a market bubble, or if there's asset inflation that is adversely, or perhaps uniquely accrued to one or more equities, they can borrow those shares and sell them in the market, and so, in hoping that the stock value goes down so that they could repurchase those shares at a lower price to close out their loan and make a profit. Now, obviously you tend to have more short selling when the market's at a peak. Well, interestingly enough, we have seen a drop in short selling lately, GameStop notwithstanding. But this actually does kind of dovetail with that prior chart, which is kind of interesting. So, it goes to the old adage that for every 5 charts that show you that the market's overvalued, there's a couple charts that tend to want to suggest that it's not overvalued, and this would be one of them. And just as you saw in our previous chart, this doesn't indicate a lot of, certainly as much froth in the market from the institutional wealth manager point of view as we've certainly seen in some other charts that we've shown you. This is a chart that kind of plots the US dollar against the US Treasury. We've shown this to you in a couple of variants, but the top end part is really what I'm going to focus on as much. But so you've got the dollar index in blue, and so it's inverted. So you see that blue line trending higher. That simply means that the dollar has gotten weaker because it's an inverted line. But you can see that there's a reasonably positive relationship between the dollar and the 10-year Treasury. Right now, the Treasury, that dotted red line on the right-hand scale, has been really, really low. And typically, I'd say that there's more of a kind of almost a lag in the reaction to the 10-year Treasury to what's going on in the dollar. But clearly the dollar's gotten weaker, and we've just begun now to see where that 10-year Treasury is coming up off of the lift. Again, this idea that if you have a weak dollar, you might be importing inflation, and it kind of goes hand in hand, really, because if you have a low interest rate, then you're less competitive, on the global marketplace, and so your currency has less demand. So now when interest rates move higher, then what's likely going to happen here is that the dollar is going to flatten out, maybe strengthen a little bit. And it's a symbiotic relationship. But again, if you have more inflation, then typically you're going to see that the upward bias on interest rates, and then that dollar is going to dovetail with that. And down below, just for the spirit of completeness, I thought it was good to show this one as well. And this is just a chart of growth versus value in the S&P 500, and as it relates to the Fang Stocks versus the S&P 500 value. You can see in both of those cases that we've got really some sustaining strength and growth relative to value, even though that's kind of flatten out a little bit. And then also say that the Fang stocks, this is a Facebook and Alphabet, which is Google, and so on and so forth. The technology stocks that were really high flyers last year, as you can see in this chart, that bloom is off the rose. And the good news is here, this is showing you that there's more participation in the market from the non-Fang stocks. And you're also seeing in this chart that value is kind of holding its head here, and it's actually not giving up any more ground to growth right now. All right, well, here's a chart of the number of index members in the Russell 2000 that are currently above their 200-day moving average. And that may seem a little abstract, but this is more of a technical indicator. Again, this is an indication that you've got a lot of strength in the market. And 200-day moving average is kind of a bellwether technical indicator, if you will, of the strength of the market. So, when you have this many companies within the S&P 200 or 2000 index that are trading above their 200-day moving average, that's exceptionally strong. And again, I wanted to kind of put this out here for historical perspective too, because it's really not often that you see something this high. I mean, frankly, we didn't see it this high, back in 2008. We certainly didn't see it, that high when the market kind of came out of its tech bubble. But we certainly do now. And again, this is, I've got point counterpoint. Here's, short interest going down overall in the market, which is really kind of a bullish indicator. And then you've got something like this, which is a technical indicator that might suggest that we're a little bit frothy here in the market. So, I think it's good to show both sides of the coin. And this would be something that would maybe give you a little bit of pause and just say, maybe there could be a retrenchment that I think, frankly, would present a buying opportunity. Here's a quick look in on interest rates. This is a chart of the 10-year U.S. Treasury yield, looking back, kind of going back before the pandemic, when we had yields that were up closer to about 1.6. And you can see that we're kind of moving in that direction right now. We had a lot of noise here in the early part of the pandemic, and then during the summer, we hit this interim trough as we had an increase in daily new cases. And there was more speculation of the need for follow-on stimulus and a lot of uncertainty in the marketplace that was driving interest rates lower. Now, since then, we've had this continuous rise, and as you can see here, we kind of punched through 1.3% on the 10-year Treasury, and we've seen the 30-year Treasury move higher than 3%, which is an area that we just haven't seen in a little while. And so, this is being fueled by several different things. So, we've already seen, like from an inflation standpoint, the producer prices and import prices are moving higher. And so the ability to hide those increases to the end consumer are going to become more challenging as we get in the months ahead. And so expectations are beginning to build, and that's helping to push these rates higher. Of course, this has implications on the housing market because the 30-year fixed mortgage rate is benchmarked to this, and the higher that we see the 10-year, the more impetus is going to be to push mortgage rates higher. which is going to curb some of the activity we saw in prior slides with regard to refinance activity, maybe even to some degree cash out refinancing, as well as overall mortgages. But there's still enough demand on the housing side that I think this number here in this chart would have to go meaningfully higher, maybe 2.5% before, or 2.25% perhaps, to where you'd see some of the chinks in the armor, if you will. This is a chart of the difference between the 5-year Treasury and the 2-year Treasury, what they call the 5-to-2 spread. So this is literally taking the yield on the 5-year Treasury and subtracting the 2-year Treasury note yield. Well, as you can see here, looking back over the last several years, that number has been quite a bit higher when we were in a position of beginning to raise short-term interest rates, but then the yield curve was steepening, and then we had a lot of compression and a lot of flattening in that curve, which was, frankly, not very bullish. When you have a flattening in your yield curve, that tends to suggest slower growth coming ahead, and so we clearly had that in 2019. Obviously, the stock market was moving higher, and we were beginning to think that we were, certainly closer to the beginning. We were, perhaps closer to the beginning of the end of the cycle than we were closer to the beginning of the cycle. But then the pandemic happened, and now we're beginning to see that steepening. So this is a sign of a couple of things. Obviously, we know that the Fed really wants to keep their throat on short-term interest rates. At the same time, we know that there's growth expectations that are being kind of built into market prices. There's expectations, there's optimism, there's this notion that we're going to get inflation, and so there's a lot more, expectation for higher yield. Expectations are driving higher yields, and that's pushing the spread higher. And I think it will continue to move a little bit higher from here. This is a chart of high yield bonds. Again, this would be an indicator that the market is not expecting a lot of trouble ahead. It's a lot of confidence, a symptom and sign of a lot of confidence in the market. So high yield bonds, the yields on those, because there's so much demand for yield right now, continue to go down. And we've shown this chart from Bloomberg to you many, many times, and each time there's a further downtick, and we're at record levels right now. This is unprecedented that we would see below 4% on high yield at a time, frankly, when the 10-year Treasury is moving higher. So clearly, investors in more speculative grade instruments don't feel like there's any trouble on the horizon. And then if you look at the right-hand side, you've got a lot of companies with speculative grade credits. These are triple C's or lower. These are companies that actually have a meaningful risk of default, that are issuing tons and tons of paper out there. Again, so this would be one of those counterpoints that says, there's a lot of optimism in the market. People aren't really, the issuers of these bonds, and certainly the marketplace for high yield is not overly concerned about what the economy and the backdrop for investors is going to look like here over the coming months. Finally, we'll end on this. This is in light of what's going on last week, just one slide of many that I could show based on the reading that I've been doing at various points when I've actually had power. But it just shows you the reliance during the winter months on gas. A lot has been made of wind. Wind has a capacity to generate up to 30% of Texas power, but generally during the winter months, the reliance falls on gas. And again, I thought this was kind of interesting because for all of the advances that have been made in green energy, and Texas is kind of like the Saudi Arabia of wind power. But even with that, wind accounts for 10% of total fuel usage and electricity generation during the winter months. So um, obviously that there's going to be a lot of legislative conversation going on about what went wrong and how to prevent something like that from happening in the future. But if you look at this, I mean, the here and the now is that you've got to spend more time protecting your sources of electrical fuel input that are coming from natural gas. That's got to be where you start, just because of the over reliance on it, as evidenced by this chart. Thought this is interesting. Certainly won't be the last thing that we're going to probably show you on that electrical grid issue that we no doubt will be reading a lot about here in the coming weeks and months. That's all we have for today. I hope you've enjoyed the presentation. Feel free to reach out at the information on your screen. We'd love to hear from you. Be warm, be safe, have a good week, and we'll talk to you again soon.